Our next speaker for this morning is Ian Beattie. Ian is the co-CIO and head of global emerging markets at NS Partners. Ian and his team have actually been managing the Nedgroup Investments Fund for about 2 years now, but they actually have a track record going back over 25 years in global emerging markets. So, it's amazing how the way they construct the portfolio, they focus on this country analysis, liquidity analysis, as well as rigorous stock selection and a really deep level of analysis on stocks as well, to construct a portfolio of about 75 to 90 stocks altogether. So this morning, he's going to be chatting to us about key themes relating to manufacturing and Chinese policy. Ian, welcome, and over to you.
Thank you, Anil. Well, you can see from the title here that we were thinking it was as good as it gets for the cycle globally, and that our main issue is that Chinese monetary policy, and fiscal policy as well actually, is much tighter than it is in the rest of the world, and in our view, too tight for where they are in the cycle. Their cycle already beginning to lose momentum. Now, what's happened since I wrote this title is that we've had some policy change in China that we think is significant, but which most market analysts are saying is just noise. So we actually think it isn't. It's a strong signal. But I'll go into this in a bit more detail as we go through. I'll also conduct a review of what's happened so far this year. So here you can see the portfolio performance. And obviously, after a period of very strong performance since inception with the Nedgroup Fund, and obviously after a long period of outperformance as well for us as on our track record, it's been a really tough quarter for us. Our instincts of quality and growth have not been the ones we wanted. And although we were expecting a cyclical rally and all that means for rotation, and we took some evasive action, which I think did well in the fourth quarter of last year. I think in the second quarter of this year, we didn't. It still really hurt us. Chinese internet names in particular. We'll go into that in a bit more detail later on. Firm update, we as a firm at NS Partners are now running just over $4.25 billion. And in our emerging market strategy, we are at $1.4 billion US. Now we have another $730 million US that is coming in now. And I don't normally count this until the dollars are actually in, and we all know what life can be like. But this, all of this money that we're counting here has had board approval at the client level. Documents have been signed, accounts are being opening. So this is just something in the plumbing, and we're expecting it in around about this quarter. I suspect most of it will be in this quarter, even if it is towards the end. We have just made an offer to somebody to join the team. So we've added an additional analyst. They will also be joining, I suspect, towards the end of next month. And we're very, very excited about that. Every time we've hired lately, we've had it's been amazingly high quality of candidates apply. Most of the team now are back in the office, and most of the firm are back in the office. I would say 3 days a week. Some of us are in 4 days a week. But again, no pressure on people to do that. The UK obviously is in a slightly different situation to other countries. Well, here we have performance by country, and you can see Brazil had a very good bounce this quarter. Russia also doing quite well. And they were really the headlines. The other big one to note is that China really in the doldrums. So, we've been overweight Brazil, India, and Russia, ex-oil and gas, and we've been underweight China. So all that worked well for us, but we didn't get paid from it as much as we'd hoped. Mexico, not really doing that much. Taiwan clinging in there. So Taiwan doesn't look like it's done much over this quarter, but it has been such a fantastic performer over the last few years. South Africa, as I'm sure you are all unfortunately only too aware, at the bottom there in red on the right-hand side, are underweight there with only a very small position in Naspers, obviously was the correct call as well. Attribution by country, all this data and more, we can go down to as much detail as you like, is available on request as well. But I think it's really about stock selection and to a certain extent sectors. it's not really, I've just done the countries. There's not that much more to tell here, really. Especially if you net off China and Hong Kong together. So you can see there, the performance is really about stock selection is where the poor performance was. China and India not being so good this quarter, having, again, as I said, doing very well over the last few years, and Brazil also letting us down, and the tech in Korea. Performance by sector, this is I think where the story all is. You can see energy there, which we've been very underweight, doing really well, and we all know that since the end of the quarter, that's given up a lot of those gains. Industrial is doing well, and that's been okay for us. We've done well in there. Excuse me, and consumer discretionary, which has done poorly all quarter, but starting to bounce back. On the right-hand side, you can see healthcare continuing to do well. Healthcare in this emerging markets is not like the healthcare sectors in the rest of the world. It's not really a defensive sector. It's a very expensive growth sector. And real estate doing particularly poorly as well. Some of the major Chinese real estate names have some solvency issues, and we're going to see that come out around now. Actually, I suspect we'll get some restructuring and maybe even some bankruptcies, which I believe actually would be incredibly bullish if that's allowed to happen. So sector attribution, like I said, I think for us, the poor performance this quarter was about stocks and sectors. So I think this is the page really to look at here. And you can see there the sector allocation to energy was a negative and healthcare was a negative, those two big performing sectors. So not having those hurt. And then the stock selection as well, although really good in real estate because we didn't own many, was quite a big negative in consumer discretionary, which is where some of the internet names are, and financials. The positives in consumer staples and real estate, not enough to offset those really. So just picking out some of the key names to give you some colour on what that was all about. Probably should start with the losers really. So let's start at the bottom here. We didn't own NIO. That's like the Chinese Tesla. Now we're actually quite big fans of some of these go-go growth stocks. We think the cash flow there is fantastic, but we're really not sure about NIO as an investment, although the cars do look spectacular. But it's a very niche. But it's been, it basically is mirroring the Tesla share price, but unfortunately we don't think it's quite as good an investment case as Tesla. And Evergreen Marine right down the bottom, it sort of tripled over this period. It wasn't that big in the index, but it's a bit bigger by the end of the period. And we really looked very carefully at the shipping companies 4, 5, 6 months ago and really liked the story in the short term, but really didn't like the story in the long term. So we chose not to invest. Now obviously if we'd have known they weren't just going to go up a lot, but were actually going to triple, then maybe we would have left some of our scruples behind a little bit. So that was something that we have beaten ourselves up on and done our sort of post-mortem reviews on. It's very clear, obviously, they're going to benefit from a tight market and rising prices, but this will not last. You can make more stuff and you can put it back on the market. So some of these bottlenecks, which we were expecting to see, not just in this sector but everywhere, will prove transitory. The big move in the inflation that people are worried about will be much later on. If and when you see income growth and banks start to lend, and that's not what we're worrying about at the moment. These are just transitory bottlenecks. And then Ping An has been a very disappointing performer, not just the only insurer on here. And then you can see the PRU there. That's the UK listed PRU. This company is in the process of transition. It's going to become an Asian company, basically. So it's selling its US business. It's already got nothing left in Europe. And that will leave it with a predominantly Southeast Asian business with some China as well, and India. And it's a very, very good business. This is a really good operating business on the ground. I don't have a lot of positives to say about their management in headquarters back in London, but the management on the ground in Southeast Asia they are really good operators. So when that becomes the main focus of the business, which should be really soon, this will become an Asian business, and we expect it to be re-rated significantly. The underperformance over this quarter was because those plans, the divesting of the US business was delayed, but we don't think it was delayed for very long. On the positive contributors at the top of this page, we've got some really good long-term winners here. Longy Green and Cattle, Contemporary Amperex Technology, are both new energy and renewable type businesses. Longy Green Energy is a battery maker, is a solar maker. Contemporary Amperex is the battery maker that you have in your cars. The reason why I tie these businesses together is not because they're both in the renewable space at all. It's because they are both at beginnings of oligopolies. Both of these industries involved huge amounts of capital being thrown at them for investing in as you build up scale and as you build up research and development. So lots of R&D, lots of capex. Both industries are now beginning to oligopolize. There's only a handful of battery makers worldwide, 4, maybe 5, and the 3 of them are getting bigger and bigger and bigger and becoming more dominant. And Longy Green is one of those. And Contemporary Amperex is by far the biggest on the car battery side as well. So both the solar business and the battery business is oligopolizing. And that means that these companies, their capex will still rise, their R&D will still rise in dollar terms, but as a percentage of sales, they will start to fall. But it won't give enough leeway for their competitors to be able to have that advantage because they're becoming so dominant. That means the returns on capital start to hockey stick up about now. That's a really good thing for a shareholder. And you can see the market starting to sniff this, and the returns have been fantastic. China Education Group is holding in there really well. All the regulatory changes that are coming about, as we were expecting, have hammered the US listed education names. This one is very different. First of all, it's listed in Hong Kong, and secondly, it's a real school, a real business. It's not pimping out tutors, which is going to annoy the regulator, and extracting a rent. It's not a banker and a broker that set up a business overnight to make a quick buck. It's a real business. It's been going for a long time with excellent academic track records. And then SCG Packaging is a packaging business. We all know how much material and packaging is arriving through our doors now with Amazon deliverers and everything else. And obviously it's done very well with that. But this is a relatively new business spun out of Salm Cement with really high quality management. We know that there's some big global firms in this space that have done really well, and they're looking to replicate that on a smaller scale, again in Southeast Asia. Really good, sharp operator. I think there's some M&A to be done there. Okay, so what have we been doing? Oh, Monday Nissen, which is obviously there, has appeared already in some of the top winners earlier in that previous page. This is a really good, solid noodle company. We were getting more defensive and more cautious, so a staple company like that is what we've been adding to the portfolio. But also, they've got an option in that they own Corn, which is a UK alternative to meat company. Now, if you're in the UK, it's like a household name. Everybody knows what Corn is, but it's not known globally. There's a first mover disadvantage here. It's one of the first meat replacement products on the market, and it's almost got too old and a bit. I don't want to use the word stale because we're talking about food, but you know what I mean. And I think it can really renovate and regenerate that brand and start growing again, because at the moment it's just high market share and not going anywhere. I think you've got a free option here as meat people replace meat in their diet for other non-meat proteins. This could do very, very well, but it's a rebranding and marketing exercise that needs to be done. They've got a new CEO in there at Corn, and we've met him. I think it was our first face-to-face meeting out of lockdown, and we meant to meet him before the IPO. So we're very excited about this business, and it's got off to a good start. Shanghai Baosite, well, if China is serious about digitalization and improving the efficiency of its polluting steel companies, you need software to do that. You need to measure the inputs and get it and calibrate that exactly right. And as the big steel companies do that, they're hiring Shanghai Baosite software to renovate and bring their steel plants up to the leading edge. So it's a very exciting business there. Honhai, well, this is what makes your iPhone, but this is the company that makes your iPhones, and as well as the Apple new product lineup looking pretty good. They're actually looking to bring their methodology, basically their business model, to cars. They're actually looking to assemble cars. So you'll buy a car with one brand on it, but really it might be assembled by Honhai. Again, looking to the future, their business at the moment, the one that makes money, is manufacturing your iPhone for you. Gazprom, well, gas is obviously looking a lot better than oil at the moment. That's all what we're doing there, really. And Hangzhou Tiger Med, again, is one of those beneficiaries of spending more R&D in the pharmaceutical industry and outsourcing it and getting it done locally in China. We've got a couple of companies like that. Sales, well, we're reducing cyclicality is the story here. So that was reducing AirTac, great little company, but it's industrial automation. If we're seeing a deceleration in economic activity, which I'll talk about in a moment, then we don't want to be too exposed there. And that's the same with Cement and Jiangxi Copper, profit taking in materials, names and cyclicals. That's what we're doing here, really. As you can see, quite a lot is the theme for this page. That's our allocation. You can see there's a big underweight in China. We are beginning to close that for reasons that I will explain later on. Big underweight in the Gulf as well. We don't think the oil price there is particularly sustainable where it is, so that should work for us as we go through. It has worked very well. Obviously, this was a bad quarter for that one. And again, you can see here we're clearly have clearly gone non-cyclical here. And why have we gone non-cyclical? Well, this is the macro part of the process, and you can see here that manufacturing PMI, we think, will top out, and we think it will top out because that's the black line there on the left-hand side, because our real narrow money indicators, our measures of money supply throughout the world peaked in July 2020. So everybody keeps telling you there's lots of liquidity out there. It is disappearing fast because it has paid for this huge bounce in industrial output and all the inventories that are trying to be built and hidden all over the world. So you see the blue line there bounce really hard with the policy response to COVID and then decelerate. We're now expecting the black line to have peaked, and so that's bad news for manufacturing. Obviously, as the economy opens up, services will recover. But stock markets profitability is more about this manufacturing PMI. And we think that's as good as it gets. Now, we're not super gloomy on this, by the way. We just think that the market was pricing in. They'd got a ruler out and extrapolated this recovery as though it was going to continue like that. And we're saying, no, it isn't. It's going to look like China. It will peak out and roll over and lose momentum. Doesn't mean that it won't recover there again thereafter. So we're not super gloomy, but just the markets have got too carried away and we've run out of free liquidity. We've run out of fuel. So it could be quite a tough summer. And then we think therefore earnings revisions, which is on the right-hand side, will roll over as well. Now, this is going to be really noisy data. So this isn't as strong a call, but it's probably not going to be as good as the bounce that we've seen. And all that means is that we think non-tech cyclical sectors are vulnerable here. And they've already been vulnerable in the emerging market. So you can see the emerging market, which is the brown, I think that's brown, line there, which has come right back. And the blue line, i.e. cyclicals in the rest of the world, are still really high. And we think they've done as good as they're vulnerable to a bit of a relapse. That might be a good buying opportunity, by the way. This isn't a secular call. It's just trying to finesse the timing here. Relative monetary trend. So I'm an emerging market manager who's not banging the table on EM here yet, but we are getting closer to it. It's the US that's leading the way on money supply still, but we think we're just beginning to see signs of China changing its policy. And if we see that, then we will start to change our mind and start to be more bullish on emerging markets. That could be very soon. So these charts are now a little bit old, as I said, because this week we saw, at the weekend, we saw a change in policy. So Chinese real money is stagnant and has been contracting. That was suggesting to us that the Chinese economy would be weaker than people expected. Now, what's just happened is that we've seen an explicit policy easing. Now, many commentators here will say that reserve requirement cut is not large enough. They've done it before. It doesn't mean anything. But it will show you what's happening to interest rates in a moment. And we think it is significant. It shows you the direction of travel. Yes, there's a structural reduction that's been going on now for some time. But this timing to us looks like it was what was needed, and I think the authorities in Beijing are on it. There's a liquidity squeeze going on in China, as you can see on the right-hand side, not for households, but for others, for companies. And we think things will be stable as long as we don't start seeing firms cut jobs. So this easing has been a little bit late, I think, certainly for an equity investor, but we're definitely seeing some easing now. And you can see that in the renminbi. So the renminbi has been really strong, which is another, well, you can take it as an indicator of tightening, or you can take it as part of the tightening itself. And you can see those interest rates that have been high starting to come back on the left-hand side. And on the right-hand side, you can see here, the PBOC is stepping up easing efforts. There was this reserve requirement ratio cut, and then you've got a rise in the loan approvals, loan demand differential in the last bankers survey that the PBOC runs. That's quite interesting because normally this is a very slight lag in many countries in the developed world, but in China, because there's more moral suasion, the PBOC has a little bit more power over its bankers than, say, the Bank of England or the Fed or most other central banks. They have this, far more apparatus to do that. Then we can actually see that happening in a more real-time basis, I think. So that's telling you they want to see some conditions ease here. That tight policy has done its job. Quick roundup on the rest of the markets. Well, you can see why we're profit taking in Brazil there on the black line has been very, very weak. And you can also see there Russia, India and Greece looking pretty good actually on these numbers, whereas China, Mexico and South Africa have been pretty poor. And that's why we're overweight Russia, India and Greece and have been underweight China, Mexico and South Africa. South Africa, of course, has got many more problems than just the money supply growth, but that's probably part of the mix. So a quick summary, if you've got one page you want to cut out and keep, if you're an investor in our fund and you want to go, okay, what's been going on, this is it. So I've gone through most of this already. We say what didn't work because it's a negative quarter. We're giving you that first. Underweight in healthcare and energy in the security selection. What did, what did work was overweight in industrials, or underweight in communication services. That's Tencent and things like that. Underweight in South Africa, of course, and China. The good, I've talked about those, Longy Green, Contemporary Amperex. So you've got your solar power maker. Solar, of course, is so competitive now. Your leading lithium battery maker and Monde Nissan, the noodle company with that meat substitute business stuck on it. Prudential, which we are keeping, we think this is just a timing issue. It's been one of the big negatives. I think that's really going to come out. That's a real strong conviction buy there. Ping An Insurance, not done very well with rates, probably headed lower, could be the reason there. And some COVID issues as well on getting your salesman out there. What have we done? Well, we've added to India, Thailand and the Philippines, reduced Brazil, added to defensive exposures, reduced our cyclicals. Going forward, we're looking to add to China as they've started to ease. And that's it on the strategy. I've given you most of that there now going forward. Thank you very much.
Thanks very much, Ian. That was really an excellent and comprehensive presentation. We've run out of time for questions, but once again, you've done an excellent job. Thanks so much, and we really appreciate your time here today.
Thank you.